Welcome to the Passive Investing Show. I'm Ashley Wilson, and I'm joined here today with my co-host, Jay Scott. Recently, Jay went to GoBundance Miami and had the pleasure to interview several different investors who are both active and passive investors. And these two brothers, Rakesh and Neal Gupta, are no exception to the rule. They are doing both active and passive investing.
Yeah, these guys are great, and their company is great. So Neal and Rakesh are brothers, and after they cashed out of their business or businesses, I don't remember if it was one or multiple, a couple years ago, they started what's called a tech incubator. And a tech incubator is basically an organization that's geared towards helping startup companies grow and get funding and launch their product. And so basically, they launched a tech incubator called KiwiTech. It's geared towards startup tech companies, and basically they strive to find tech founders who are looking to build their companies, who need help building their products, typically software products, and they will go in return for equity in the company, they'll provide support helping these founders build their software and grow their company. So that's half their business. Half their business is basically incubating tech startups. The other half of their business is they then bring in investors from the outside to invest in these businesses. So you may have heard the term angel investing, which is basically a way to invest in early stage startup companies, specifically in this case, tech companies. So for anybody out there that's really interested in learning about how tech startups get started and how you can invest in these early stage tech startups, Neal and Rakesh have a ton of information, both general information about how angel investing works, but also specific information on how their incubator works and how you can invest in companies with their incubator. So without any further ado, let's welcome Rakesh and Neal Gupta to the show.
Rakesh, Neal, thank you so much for joining us on the Passive Investing Show.
Thank you. Our pleasure.
So we talked a little bit about your company, KiwiTech. I want to introduce that to our listeners and get them more information about that company and you guys. So can you tell us a little bit about your backstory and where KiwiTech came from?
Sure. It's the same founding team pretty much as our last company. Our last business was a content technology services business, which we scaled to 5,000 people worldwide. Did some interesting projects. We populated the Medline database for National Library of Medicine, which every doctor uses. We did 35% of the Edgar SEC filings, financial filings for public companies, a lot of scientific books and journals, legal documents, e-learning. So a business which we really scaled that we're very proud of, and we ended up selling 10 years ago, and along the way started investing in startups, and then came across this opportunity that we're doing now at KiwiTech.
Awesome. So let's talk about what KiwiTech is. So KiwiTech is an incubator. A lot of our listeners may not have any idea what that means. So can you talk to us a little bit about what KiwiTech is, what an incubator is, how you work with startups, and how you work with investors?
Yeah, so KiwiTech is essentially it's like a Y Combinator using technology development. Y Combinator is one of the very popular incubators out of the Bay Area, which you're familiar with, Jay. And Y Combinator does basically mentorship and learning, education, in exchange for equity in startups. At KiwiTech, what we do is we do software development in exchange for partially in equity and partially in cash. So say we're going to do $500,000 worth of development for a startup. We would do, they'd give us $250K in equity. Say their valuation's $5 million, we'd get about 5% of the company. And the other $250K they'd pay us in cash over the course of the development. So what this does is it gives them development at a very subsidized rate. It also gives them a strategic partner because we're vested in their success. So we want to help them succeed. And we do that through an ecosystem of events. We have about 100 events in a year, demo days, VC panels, family office panels, and other types of events.
Okay. So I kind of think of this in two ways. One, your mission is to find startups that need help to grow, to create and build their products on the technology side. And so you nurture them, you help them with that product development in exchange for some equity. I presume you help them with other areas of their business growth, marketing and finance and accounting and all those other things. And then the secondary phase is you help them get investment to grow the company. And you do that by working with outside investors. Fair to say?
That's right. Yes.
Okay, perfect. I'd love to start on the startup side and your relationship with the startups. Can you start by telling me a little bit about what types of startups do you work with? Is there a particular industry? Is there a particular size startup? Is there a particular location or type of founder that you work with?
So generally, we're working with U.S. startups. I mean, we started working with startups outside the U.S. as well, but they've been primarily U.S. startups so far. And what we're doing is we're doing the software development. So they're usually startups where software is a key component of their business, and it's across vertical. It might be prop tech, it could be fintech, health tech, across vertical. We like the broad variety. Today, we've invested in over 500 startups. We like the variety because you don't know which space might emerge as a leader. We happen to make some crypto and NFT investments over the past couple of years. That's turned out very well, and we're adding a special focus on that now. So we're setting up a special group and plan to do 25 crypto, NFT, blockchain investments over the next year.
Awesome.
So when we see an area that's developing, we can say, hey, let's focus in on that. Let's build out that portfolio.
Got it. So 500 companies. Do most of your companies, do you have a physical location, or most of your companies remote and they work with you virtually?
Well, these days it varies a lot. Most people have kind of dispensed with having an office, especially at the early stage, because they can work virtually, they can save that money, they might be saving money on founder salaries as well. One of their main expenses actually in the beginning is developing their software. So that's where we help them. We reduce the amount they have to raise to get that done, pre-institutional financing.
Got it. And what does the structure of the company look like? What is the team? Is it just the two of you, or do you have a large team that supports these startups? What does the structure of the company look like?
In terms of KiwiTech, we are headquartered out of New York City. Mm-hmm. We have people around the country. We have a development center in New Delhi, India. We have about 650 people in the company today, about 50 people in the U.S., about 600 people in India, and that's a number that's growing fairly rapidly. But that's how we're set up. The people in India include developers, graphic design, UI, UX, project managers, business analysts. So it includes a whole variety that you need for a project.
Got it. And so I presume that the majority of the companies that come in, and maybe correct me if I'm wrong, are pre-revenue. Basically, they have a great idea, they're developing the product, and then they come to KiwiTech, and the goal is to kind of
jump in. Yeah, that's a great question. We look for companies that have revenue, actually. So the way we differ from normal incubator like, say, Y Combinator is they take an idea on a paper napkin and help a team mature that idea and take it to seed stage. We look for seed stage companies that are past the incubation stage and hopefully have revenue. Some of them don't, but we're betting on the team. Usually we're betting on a seasoned team. Our idea is more doubles and triples rather than necessarily unicorns, although some unicorns are developing in the process.
Got it. And so when you say they have revenue, have they raised money prior to coming to KiwiTech?
Most of our companies have raised money. We'd like a company to have raised, say, $500,000 or so before. Maybe they're going for their next round of $500,000 or $1 million, and we're part of that round with about $250,000. But we invest with their services rather than cash.
Got it.
So that's money they either don't have to raise or they don't need to raise. Yeah.
Got it. Any particular industries that are you're heavily focused on? You mentioned blockchain over the next year. How about historically? Any particular industries or technologies?
Yeah, it's been pretty spread out over different verticals, and this is probably the first time that we're taking a specific focus. We're seeing something that's emerging. We think Web3 is an exciting area. There's a lot of hype, clearly. But there are a lot of interesting companies that we think are going to emerge out of this. I mean, kind of similar to .com. When the .com boom happened, there were a variety of companies that didn't make sense, but there were some really good companies that came out of it. Amazon and eBay and a number of companies.
Yep, that's great. Okay, I'd love to transition now a little bit and talk about the investor side, because a lot of our listeners are investors. They're looking for investments, and I'd love to help them understand how they can work with KiwiTech, how they can work with the startups in KiwiTech. Talking before this discussion, you mentioned that you hold a number of investor events. So can you talk a little bit about that?
Yeah, so we have events. We do about 100 events per year. That ramped up after the pandemic started because with the advent of Zoom, we were able to do a lot more events. We have typically 100 to 300 people attend an event, and then the video goes out to more people. The demo days are a format for our portfolio companies to be able to raise money. So it connects them with investors, accredited investors, might be VCs, and a number of the events are kind of centered around that concept: connect startups, investors, and mentors. And the opportunity is for people that are looking to invest in startups to see a variety of startups and invest directly. We don't take any fees because for us, these are already portfolio companies in which we have equity, so we want them to be able to go raise money, and we want to help that happen.
Yeah, which is great. It sounds like KiwiTech isn't just the incubator; they're also a partner to both the startup because they have equity and partner to the investors.
Yeah,
as well.
and a lot of it came from our own experience and pains as an angel investor. We found that it was really difficult to make direct investments, and a lot of families that invest alongside us, they've tried direct investing, and that's not an easy thing to do in early stage tech. And of course, you can invest in funds. Then you're paying 2% a year or 20% over 10 years plus carry. So a lot of family offices and individuals are looking for direct deals. We find that our platform is a diversified way to invest in early stage. We actually give a cash return to investors who invest in the platform company, and also the companies that we have in the portfolio. We know many of them for many years. So it's you're not investing just on one presentation. You're investing with confidence that KiwiTech's known this company for 2 or 3 or 4 years, and they've seen them progress. So, they can lean on us for diligence and advice on these companies.
Are the investors, do they have an opportunity to talk to the founders or people in the company? Do you facilitate those relationships as well?
Oh, very often. I mean, that's probably a daily thing. Rakesh and I are in touch with probably the top 5% of the portfolio, top 25 companies, but our team's in touch with all 500. But, if an investor tells us, I want a health tech, startup to invest in, we'll show them our top 5 health tech startups and say, talk through it and, give them our opinion. And, investors can make their own call and talk to the founders of these companies as well.
Got it. And so an investor goes to a demo day, sees a pitch they like. They may talk to the company, decide they want to make an investment. What does the investment vehicle look like? Are they getting equity? Is this a convertible note, a safe investment? What's the typical investment size?
Yeah, so usually it's a convertible note these days, but it's up to the company what they're offering. There are safe notes. There are some rounds are preferred equity or common equity. It's really a kind of a negotiation between the group of investors, initial investors, and the founder. But yeah, it's a variety of different instruments.
And what's the typical investment size?
So typical size is anywhere from, I would say, $25,000 to $250,000. The sweet spot for these startup investments is usually $50,000 to $100,000. We're able to go in with a little bit more because we're doing in-kind. So our typical investment is about $250K on the in-kind services.
Okay. I'm going to ask kind of a general question, but I think this is one of the goals of this show is to help our listeners learn. For our listeners that may be new to angel investing, new to tech investing, they might go to a demo day and they hear something they like, they're ready to make an investment, but they're just a little bit scared to pull the trigger. What are some things they can do to facilitate their due diligence? What should they be looking for? What questions should they be asking? What should they be considering before making an investment?
So what we look at is that we look at the founding team, because especially in these early stage startups when they're pre-institutional financing, it's really about the founding team, and the idea is important, but I would say it's second, because the founding team is going to pivot. They're going to figure out how to make it work. And the companies that we've had become successful, that look like they're on a path to being a unicorn or have a nice exit, those are really companies that typically have pivoted once or twice. Especially after the pandemic started, there were a lot of companies that had to pivot. There are travel companies, food tech companies, and others. And ones that did it well have emerged better out of that situation.
Awesome. Neal, do you have any other thoughts on, from a due diligence standpoint, what we should be looking at?
I mean, yeah, I think as Rakesh said, we like to look at the founding team, and very often companies do pivot. They don't stick to the same business model, throughout their life cycle. Of course, industry, if an investor has experience in a certain industry, if they have a lot of experience in financial industry, for instance, they might be interested in looking at some fintech startups where they can delve into more and understand more from their perspective and have better knowledge of. So yeah, and obviously progress in terms of does this company have revenue? We find that to be a hurdle that kind of reduces risk for us. If a company has product market fit, that means they have some revenue. We look more and more for that as well.
Got it. And for investors that may want to be more hands-on than Zoom calls and seeing it there, do you do any in-person or live demo days?
Yes, we used to do that exclusively. I mean, there used to be demo days around the country in different cities, and we did about 30, 40 demo days per year before 2020. We're bringing them back. So we're bringing back some live events, but it's going to be a mix of virtual and live events but people are wanting to meet in person, and we're starting to bring that back.
Yeah,
so
we just had a Kiwi social at our New York office, which is near Bryant Park, and we are actually in 2 weeks having an interesting live event in Saudi Arabia in Riyadh. So that's kind of interesting as well. Yeah.
Do the startups graduate from KiwiTech, or is this kind of a relationship they keep forever? How do you think about your startups as they evolve?
I mean, they graduate in terms of maybe their software development after they raise an institutional round. They might say, I'll just bring that in-house. And it's okay to me that it costs more, but I'd rather have it in-house. So, or they might use a mix of in-house and at KiwiTech. So, and we're completely open to that because we have equity. Our purpose is to get equity in the startups and help them grow. So whatever works best for them, we'll help facilitate that, help transition if they want to take it in-house. So that I guess you could think of that as a form of graduation, but the relationship continues because we're shareholders.
Got it. And so, again, for our listeners that may not be familiar with angel investing or investing in companies, a lot of our investors have invested in more traditional assets like the stock market and real estate. What does a typical life cycle for an investment look like? And I know it varies, but what can they expect? Is this going to be a 2-year investment, a 5-year investment, a 10-year investment? Is there going to be cash flow involved or simply a payoff at the end? What do the multiples look like? And obviously, there's always the risk of losing all your money, but on a successful deal, what's kind of the gamut of what investors can expect?
Well, I'll start off, and then Neal probably would want to add on to this. But typically, if say you're investing in real estate, you have a hard asset. That asset's not going to go away or disappear. It's very unlikely, right? So, but in a startup, it can go to zero very quickly, and it could go to zero. I mean, there could be a variety of reasons that happen that are beyond the control of even the founders. So diversification is really important. I mean, it's important. There's some mathematical analysis on this where they say that the ultimate, 5 startups is kind of risky. So if you're going to place bets, better to place bets across a number of startups in an educated fashion with some consultation with others and doing your diligence. But say 20 startups is a good sized portfolio, So if you're going to do this, then it's better to be well diversified. If you invest in 5 startups, it's possible you end up with 0 because all 5 could go to 0. But if you end up investing in more, you have a better shot, which is why we like our model, which is highly diversified at 500 startups. Another thing is time frame. If most startups, there's no current pay like there is with real estate. You're waiting for a long time for an exit, so it might be 4 to 8 years is probably what you should expect, and expect it to be illiquid and not be able to get out for that period of time. So that's, do you want to add on to that?
Yeah, I mean, it's interesting your show is called Passive Investing because that's kind of the genesis of our model. We tried investing directly ourselves after we sold our last company, invested in about 35 companies, just like a regular angel investor writing checks, and found we were probably better operators than investors, like a lot of your viewers maybe as well. So that's one reason we really built this model. It's become like a passive investment model for us because 500 startups scaling to 1,000, but at the back of it there's backstop is a software services business which has value. So we look at it as a portfolio approach. So you invest in one startup, it could go to 0, maybe you could get 10x, 20x, 100x if you're really lucky, right? But we see it as can we get 20, 30, 40% IRR on the portfolio? So that's how we look at it. And without having to really manage the portfolio, because there's so many companies, you're not going to be really managing that many companies, right? But we're there to assist when they want us. But we're not really digging into each company.
No, that's a great explanation. So 4 to 8 years, 20, 30, 40% IRR, with obviously it's a portfolio play where if you're not diversified, it could all go, even if you are diversified, it could all go to zero. But by the same token, if you're diversified, every company could 10x or 100x. So it's all over the map, but diversification in portfolio is important.
Right, diversification and then doubling down. Like, say a half dozen companies that we see in a portfolio, maybe potential unicorns, we may want to start doubling down on that. But KiwiTech itself as a platform, we see that as being 5 to 10x return over the next 2-3 years. But I'm talking about just purely the portfolio side of things. It could be like 20 to 40% IRR. But again, I'm talking about investing in services. So the IRR is our book value, which is 120 million now. Maybe that goes up 20 to 40%. But again, we got all that 120 million from services. So that didn't really cost us 120 million. So if you look on cash IRR, it's actually a lot more.
Yep. So I guess starting a KiwiTech is actually the right way to go. No, I love that. And I think one of the things our listeners should keep in mind is for a lot of the investments that we talk about on the show, especially when you're talking about real estate or other big assets, a lot of times the investments are in the six figures. You're investing $100,000 or $200,000 or $500,000, but the investment might be backed by a hard asset. It might be lower risk, lower return. In this case, when thinking about investing in businesses, typically the minimum investment is lower, like you said, maybe down to $25,000. So you may still want to think about allocating six figures, $100,000, $200,000, $500,000, but you're not going to allocate it to one investment or one company. You're going to diversify. It's actually one of the things I love. I invest in all asset classes or a lot of asset classes. One of the reasons I love angel investing is because for the same amount of money, I get to watch 5 or 10 or 15 or 20 companies that I've invested in. That's fun for me. So let me ask you a question. So, and I know this is just a personal question, but from a diversification standpoint, should our listeners be thinking, pick an industry that they know and that they like and just invest in a bunch of companies in that industry? Or should diversification consist of investing across industries, investing across locations where the companies are located, maybe investing across industries that are negatively correlated economically. So if there's a downturn, one industry might be recession resistant, another might be heavily correlated to the stock market, whatever it is. What are your thoughts on how to diversify in a portfolio for angel investments?
I think it's good to invest across verticals. I mean, of course, an area like if someone's a real estate investor and says, okay, I understand prop tech. I think I have an idea of what people would want to do in real estate.
And just real quick for our listeners that may not know what a vertical means.
Yeah.
What is
like an industry.
Okay.
An industry. So if you're in real estate and you want to invest in prop tech or real estate tech, that makes sense because you have knowledge about it. But it also, as you say, kind of aligns you with what's happening in the real estate sector, and is real estate tech going to really take off, So having that diversification be across vertical, I think, has value. But when you go outside of an area you don't understand, like healthcare, or you go to fintech, it's good to consult with people like friends or people who are knowledgeable about that field to learn more about it, Yep. I'm wearing my Bitcoin hat and my crypto startup shirt. And this is an area that I've been learning about. I've been learning a lot about Web3. And what I usually do is if I'm looking at a crypto startup, I'll consult with someone who's an expert in that field because I'm not an expert. I'm learning more about it, but not an expert. So I think it's always good to be collaborative with others and find out and get them to take a look at it and say, what do you think about this?
Great. So let's talk a little bit about Web3 and crypto and blockchain. I think a lot of our listeners have heard the term crypto. They've maybe heard the term blockchain, NFT, Web3. That's kind of a new term for a lot of us that aren't really involved in technology. What does Web3 mean?
I mean, Web3 being kind of a catch-all for crypto, NFT, blockchain, and it's an area that I would say has potential for a lot of growth. Personally, I have a lot of friends who invest heavily in Bitcoin or other, crypto assets, but I feel ultimately making picks and shovels for the gold diggers is a better strategy, because the platforms that are taking advantage of blockchain and Bitcoin and using that to create new services or more efficient fintech companies. With DeFi or decentralized finance, you can do transaction domestically, internationally, much more seamlessly, much more efficiently than a bank. So these platforms, I think, are the real win. And that's where I think you'll see significant value creation. Will Bitcoin go up by 10x in the next year? Probably not. But a crypto startup or an NFT startup could. So there's an opportunity for a lot faster value creation in doing picks and shovels for the gold diggers.
Yep, I 100% agree. I kind of look at crypto and blockchain today the way I was looking at the internet back in 1998, 1999, 2000. It was hard to necessarily pick which company, whether it was going to be Amazon or pets.com or a million other websites and web companies that may have gone away and some have gotten huge. You didn't know who the winners and losers were going to be, but it was pretty obvious that TCP/IP and the internet was going to be a winner, and it wasn't going away. And I kind of look at it the same way today with blockchain. We don't know if it's going to be Ethereum or if it's going to be Bitcoin or one of the other altcoins, or whether it's going to be one company or another company that's necessarily successful. But it's pretty clear that blockchain is here to stay, and the technology, the foundational technology, is probably going to be around forever. And so it's a good industry to bet on, again, as a portfolio play, because back in 2000, everybody might have thought pets.com was going to be the biggest company in the world. It turned out to be a little bookseller called Amazon.com. And had you done that portfolio play back in 2000, you probably made a whole lot of money. So do you have companies that you're currently incubating in the crypto and blockchain space, or is that a goal over the next year?
Yes, we do have some companies that are doing well. We have an NFT play where they develop. It's an NFT for enterprises platform where enterprises can come onto the platform and they can have their own NFT play without having to do a lot of work. So it's more like a SaaS platform. Then we have another company which is a crypto lending and borrowing company for institutional players, so not just for retail investors. There are a lot of plays for retail investors. So we have one that's for institutional. And we have some blockchain companies as well. So we've dabbled in it so far. I mean, I don't know what the exact count is, but maybe like 5 to 10 that we have in that space right now. But our plan is to kind of focus in on this and add about 25 over the next year.
That's fantastic. And I don't want to harp on it, but I'm a big proponent of angel investing in crypto and blockchain and NFT as opposed to buying the coins.
Yes.
When you buy the coins, it's something you don't really control. There's no hard asset there. I like owning the equity in the companies that are developing the technology, and so that way maybe the coins will be successful, maybe they won't, or the tokens or the technology, but they always have the opportunity to pivot. When you buy a coin or a token or a single NFT, you're not diversified and you don't have much control over what happens. But when you're invested in a company that's run by smart people that have the opportunity to pivot and repurpose their technology and build great core technology engines that can be used for lots of different things, there's a lot more opportunity there.
Yeah, I think in investing in the coins like Bitcoin, Ethereum, or even some of the newer coins, that opportunity was over the last maybe 2 to 10 years, right? I mean, if you were early and you did that, the appreciation was fantastic. Yep. Now, the question is, there going to be that level of appreciation going forward? I think right now we're seeing a lot of volatility. There'll be probably some appreciation on an ongoing basis, but we don't know if there'll be that kind of appreciation going forward. And you don't know which ones are going to emerge as the leaders, as you said.
Yeah, I think you make a good point, Jay, and it's the difference between speculation and investing, right? If you're investing in the coins, it's probably more speculation now, whereas you're investing in the technology, that's really an investment.
Yeah, I think of it as I'd rather invest in Apple than buy a bunch of iPods or iPads, which, who knows, maybe they'll go up in value. Yeah, okay. So I'm going to give you the opportunity, brag about a couple of your companies. So tell us about a couple of companies either that have gone through the incubation process and have now been successful, or tell us about some companies that you're really excited about today that we may not
have heard of, but we may hear a lot about in the next couple of years?
Yeah, so we have one company called LVH, which is Airbnb for billionaires. So there are a lot of the wealthiest people in the world that travel with them. These are kind of very nice vacations, and it might be in Saint-Tropez or Mykonos or Bahamas. And this company, during the pandemic, after the lockdown, of course, business went to zero. And then just as a few months after that, starting in September 2020, it took off because everybody started traveling and they didn't necessarily want to stay in a hotel. So they wanted to rent a villa where they had a secure space, a clean space. And that company has done very well. It's scaled quite well. They're raising a significantly larger round now and are going to continue to grow organically and through acquisition. We have another company called Hungry, which is a food tech company. It's chef-prepared meals delivered to residences, to offices, and that company also is probably on a path to an IPO over the next couple of years. So we have companies such as this that are, have progressed quite well. And we came into them early. We came into LVH at a $5 million valuation, and we came into Hungry at an $8 million valuation. And now their exits are likely to be in hundreds of millions or maybe billions. So we'll see what happens.
I love that.
And yeah, the NFT company you mentioned earlier is quite interesting as well. And another point I'd like to make is, KiwiTech tries to support founding groups which are somewhat disadvantaged in terms of raising capital. Like women founders only get access to about 2% of venture capital. Minority founders, African American founders, about a quarter of our companies are women-founded companies, and we have a number of companies, maybe about 15%, which are African American founded, I believe, minority founded as well, a large percentage. So we try to support entrepreneurs in different categories like this, and also have specific events for them, women founders demo days and African American founder demo days and all that.
That's fantastic. How about geographically? What countries do you have founders hailing from?
Well, most of them are U.S.-based startups,
Okay.
but we are starting to do some investing in like the Middle East. Mm-hmm. We've done some in Qatar. We're going to Saudi Arabia, and we're doing some in Europe as well.
Love it. Fantastic. Well, for any of our listeners that may be interested in learning more about KiwiTech or may be interested in investing in some of the startups that you guys are growing, how can they get in touch with you? How can they find out more?
Well, they're welcome to reach out to us. Probably Neal's address is the simplest, neal@kiwitech.com.
Okay.
And welcome to reach out to us. Happy to talk more.
Okay, and I assume if they go to kiwitech.com, they can sign up to be notified of the demo days and investment opportunities.
Exactly. Our events are listed on the website. Yes, kiwitech.com.
Fantastic.
We've had 10,000 people attend our events, so there's still a lot of people have heard of us through the events as well.
Wow, that's fantastic. Neal, Rakesh, thank you so much for being with us. Thank you for telling us all about KiwiTech and the opportunities available to our listeners.
Thank you, Jay. Appreciate it.
Thanks, Jay. It's been a great time.